Welcome to the ARMR report. ARMR stands for Algorithmic Risk Management Research. I'm your host, Brett Rosenthal. This is a live trading desk. We're investing in stocks, the U.S. equity markets primarily. I like to say this is not your father's market. It's not your grandfather's market. This is a millennial stock market. Since 2008, there's been a dramatic shift in the way markets have behaved, primarily because of two things. One, central bank intervention at a scale never seen before in history. And two, algorithmic activity. So in order for us to be successful as investors and to outperform the market, which we did in a dramatic fashion last year, markets were down across the board and at a rate of more than 2 or 3 times what our investment approaches were able to achieve here. And we did it because we were protecting capital first and capturing upside when we could in an incredibly volatile market using proprietary algorithms and understanding that when central banks pull back on their liquidity, markets suffer. Those are the two key factors to managing money in the millennial market. And I'm going to share with you all the knowledge I can from 30 years in the business doing this. So the information I'm going to impart on this show and every show at 12 o'clock every day, and I do a 5-minute or so morning meeting to get you ready for the trading session every morning on YouTube. I'm sharing information that I'm literally using to manage my own capital and that of investors. We work with an affiliation to Interactive Brokers, and so that's how we work with individuals. So without further ado, the first thing I like to go over every day, as you all know, is what our algorithms on the top 5 indexes are telling us about the market today. Should we be adding risk or subtracting risk? So we have proprietary algorithms that help us determine the probabilities and statistics of market movement. And if the reward is worth the risk, we put capital to work. If statistically the numbers are there for a higher market, but the reward versus risk is not appropriate, we still don't put money to work. And I'm going to get into that in a minute. But for the sake of time and trying to run this podcast effectively, I want to share with you information as we go. So step 1, information 1. We have the algorithms that tell us about risk on, risk off structure for the whole equity market. We trade and invest in the S&P, the NASDAQ 100, the Dow, small cap index, momentum index. 5 indexes we follow religiously, and it drives all of our decision making. We've been risk off since December 4th. In 2018, we outperformed every major index using these algorithms and these strategies. I expect we'll continue to be able to do that in 2019. This is a live trading desk, so sometimes the phones are going to ring. Some calls I'll take, some I won't. Okay. How are we going to outperform? We've got a lot of alpha right now in our portfolios. Markets are down dramatically. Our portfolios are not down dramatically. We've protected capital. So now there's that tug of war between when do we put capital back to work to capture that alpha versus remaining in a cash position and protecting capital because we expect further downside. We are still in a protecting from further downside mode. So that's step 1 of this call today. All 5 indexes are telling us remain defensive. We are in day 8 of the rally attempt off of the market lows. Is this the beginning of a whole new bull market? Or is this just a rally in a bear market downtrend? That's really what we're trying to determine. If we, statistically speaking, if our algorithms are telling us, yes, this has the potential to be the beginning of the next major upcycle in the market, then we're going to put risk on. If, however, based on the algorithms, this statistically speaking appears to be a rally and an overall downtrend, then we don't add risk. So let me just give you I can't tell you every piece to the puzzle that goes into our algorithms, right? It's a lot of hard work over a number of years. But I'm going to just highlight some things that we look at to help us determine the answer to those two questions. The questions being, is this the start of a next bull market run, or is this a rally in a downtrend? If it's a rally in a downtrend, then we don't want to put a lot of risk on, and we want to, in fact, in aggressive accounts, short the rally at key locations, okay? If this is, statistically speaking, a ripe environment where it could be the bottom of the market and a nice bull market's going to extend from here, then we want to put money to work, all right? The 5 algorithms are telling us remain in cash right now. Here's a couple of reasons why. We like to see a lot of volume come in at market bottoms and on rally days. We're not seeing that, which is really interesting because we're at the end of the year. Okay, volume can be light, but in the beginning of the new year, on up days, you expect to see a lot of volume. We're not getting that. Statistically speaking, based on our algorithms, we're not getting that. So that speaks more to a rally and a downtrend than it does the beginning of real institutional money being put to work in an aggressive fashion, which will be the beginning of the next upcycle. We also have to recognize the market collapsed in a very short period of time. Statistically speaking, the first move off the bottom does not offer enough reward for the massive amount of risk we have to take in order to get the reward. The market is routinely moving 3 to 5% on a given day. That's a lot of risk. I'm talking about going from 85% cash or 80% cash to 100% invested, and then the market has a 5% reversal. I mean, that's a lot of money to lose in an afternoon. So the risk is enormous right now. And the reward from here, based on the way the market's behaving, is not significant enough for us to take that risk. So those are the basic reasons why we're not getting long yet. In fact, if you look at the NASDAQ 100, it's rallied right up to the downtrend it's been in since the peak of the market last year. So it cratered, let's run right up to it today, testing that downtrend. And of course, downtrends are fluid, okay? Trends in general are fluid. I mean, the market could go up again tomorrow, break out above that trend, only to reverse and crater the next day. So the trend line is just a place where we start to look for particular behaviors. And if we get those behaviors, we act. So in this case, the NASDAQ is back to the downtrend. The 50-day moving average is even higher, so it could easily go up there. And when we get to those key, what we call locations, we start to look for behavioral changes that would either get us short or suggest we should start adding risk to the portfolio, getting long. The other indexes, the small cap, the Dow, the NASDAQ, the S&P, and the momentum indexes are not even close to the downtrend yet, all right? Which should suggest there could be more upside in this market. It's possible. You know, we had a very aggressively down market, so we were wildly oversold. And a normal rally back to the downtrend or back to the 50-day moving average, totally and completely acceptable. It's typical in a downtrend. Is it something we want to commit capital to? Not for us, because the reward for the risk we're taking is not good enough in the market right now. And so we remain defensive. Emotionally, it's a difficult time because you've seen the market crater and you look at all these great opportunities. I had a client call up the other day and say, geez, look at the PE on this stock. Isn't it worth buying because the PE is so cheap? And I had to discuss with him the value of PEs in a market in the millennial market. Okay. I've never thought there's been any value in PE ratios. Ever. I've been doing this 30 years. It's a statistic people hide behind to justify bad investments. It's a statistic people hide behind to justify bad investments. Some of the greatest stocks in the last 30 years had zero earnings. The PE ratio was unlimited, right? And yet the stocks went through the roof, had a multiple 1,000% gains. One of the best investments in the world's been Amazon. That company didn't make money for years. Don't talk to me about PEs. The PE ratio at GE looked great 6 months ago, 9 months ago, 12 months ago. GE went into the toilet. All right? Don't tell me about PE ratios. They mean nothing. God, don't get me on that rant. So then, Brett, what puts stocks up or puts stocks down, you're asking? It's investor perception of potential growth, and it's liquidity, guys. It's liquidity. It's money being added to the stock market or subtracted from the stock market by central banks. In the last 20 years, particularly the last 10, that's what guides the market, not some random PE that you think looks too good to be true. Not a reason to put money to work. Okay? Not a reason. You got me off on such a rant. It makes me so angry that I have to try to contain myself. People are so misguided by most financial advisors out there, most financial planners out there. Diversify, you'll protect yourself. It didn't help you at all in 2008, so that doesn't work. Okay? Diversifying doesn't work. That's just a lazy way of someone collecting their fee. Buying low PE ratios doesn't work. Okay? Micron's PE ratio was low at 9. It was low at 7. It was low at 5. Now it's low at 3. The stock keeps going down. What difference does it make what the PE ratio is? Please. I was buying shares of Illumina at $1.50 20 years ago. It's $300+ today. And 20 years ago, it didn't have any earnings. Right? You make a fortune on companies that have new technologies, that have new investment opportunities, that have high barriers to entry, high IP. Don't talk to me about PE. Talk to me about IP, intellectual property. That's what puts stocks up. High moat. People can't get into the business that you dominate. That's what puts stocks up. Okay, enough of that. Right now, Rule 27 is in order for us to follow. Okay? I'll just round out this thought for right now. Rule number 27, go look at our website, rosenthalcapital.com. Check out algorithmic risk research. You'll see a post I put up called Rules of the Road. 30 years, of doing this. I'm sharing with you the rules that I've learned. Rule 27. 2 up days in a row means nothing in a downtrend. It's totally normal. Market goes up 2 days in a row. So it was up on Friday, up again today. Totally normal. It's day 3 that matters. What happens tomorrow is going to be more important to me than what's going on today. This is true about a couple days ago. Last week, the market was up a couple days in a row, and I came on and I said, guys, be careful. 2 days in a row means nothing. And then Thursday rolled around. The market imploded. Okay, then it recovered Friday because of the Fed speak and all that stuff. What really matters to me is what happens tomorrow. Today's nice. I'll go over the day trade we have on today, and we're making money. but it really doesn't change a risk-on approach just because the market goes up a couple of days in a row. In fact, the market is evidencing a lot of behavior of a rally in a downtrend where it has to work off the massive oversold readings before it goes down and takes another peek at the lows. A low volume rally. You can't put more than 2 days in a row together before going down. So even though we're in a little bit of an up market, it's chop, it's destruction, it's rip higher for some Fed speak. Then we see what happens tomorrow. It might change my opinion a little bit if we can get 3 days in a row on the upside. Maybe it's more constructive, but it wouldn't get me to put a lot of money to work, but at least it'd be more constructive. Right now, this just means nothing to me. So that's rule 27. We got to see what happens on day 3. Let me draw to your attention a string of tweets that I put up today on our Twitter feed. You can find that at hashtag ARMR Report. You can look at Brett Rosenthal, B-R-E-T Rosenthal. Northman Trader, somebody I follow, put out a phenomenal piece on the stock market and central bank intervention. The definitive piece. I encourage you to click on the link and go read what the author is saying about the correlation between central bank intervention and equity market rallies and failures. It's what we've been saying here on the ARMR Report since we got started doing this. All of our clients know we've had this opinion for the last 10 years, and it plays right into my rant about PE ratios. The market goes up or down when central banks add liquidity, it goes up, and when they're reducing liquidity, it goes down. You want to know why the market went up in 2016, 2017? Read this report. I'm going to read it for you. More than $5 trillion were added to equity markets and liquidity in general in 2016 and 2017, making a total of $15 trillion, courtesy of the Federal Reserve, the ECB, and the Bank of Japan during this bull market cycle. And you're going to talk to me about PE ratios? $15 trillion or large S from central banks have been putting the market up. So why did we run into a brick wall in 2018? Go read the story. Author outlines it step by step, how each central bank has been reducing its liquidity. And I've been talking about that ad nauseum since August. Anybody following the show knows it. Central banks reduce liquidity, markets go down. That's why I've been writing a blog post called Stalking the Bear. So is this the time to start putting a lot of risk on again? Just because the Fed on Friday said that if things get worse, maybe we'll stop raising rates? Come on, guys. Come on. That's just jawboning. That's a market that's wildly oversold. Market goes up because the Fed says something that's a little less hawkish. Give me a break. And I tweeted out on Friday that this market, I believe, is going to ultimately be a prove-it market. Yeah, there could be a day or two of the market rally if the Fed says something nice. But the downtrend, I believe, will stay intact. If it doesn't, I'll change my tune, guys. I'll change my tune. We'll use the algorithms. We'll put money to work. But if the downtrend remains intact, like I believe it will, and that means we'll get the right setup to be shorting the market over the next week or so, and we'll be adding shorts, and the market goes lower, I submit to you that 2019 will be a year where the market cares more about the Fed's actions than its jaw-boning words. The Fed will literally have to stop raising rates and probably have to stop reducing its balance sheet. And perhaps the third thing it'll have to do is start adding liquidity for this market to go back up in a meaningful way. You heard it here first, or maybe second, because Northman wrote that whole thing. But if you've been listening to me for the last, I don't know how many months now, this is what I've been saying to you. And I believe 2019, and you heard this here first, will be a year where the market cares more about Fed action than it does words. And this rally on Friday will be a distant memory, probably 3 or 4 weeks from now. Because the Fed has to literally act for this market to believe it. That's my opinion. We'll see what happens. But I like when fundamentals and opinions mesh with the algorithms. The algorithms stay in cash, and I think I understand why, and this is the reason why. All right, I told you I'd talk a bit about our before I go, I'm going to talk a bit about day trading. I love to day trade in an environment like this. High volatility means high reward on a day trade. So we have our proprietary algorithms written to trade on their own. I don't have to do anything. Algorithms trade. And today we got a beautiful entry on the triple Qs at around 10 o'clock. So the market opened flat. Now I told you, those of you who listened to my morning call, that what I'm looking for personal trading, not the computer, but my own trading, is big moves up or down during the day and reversals on volume. We haven't had that today. So I haven't been aggressively trading on my own at all. But our algorithms that are written to perform, and they perform really well in a bull market. So maybe that's, maybe that's a good thing. Maybe the market's doing better than we think. Certainly the small cap index is leading the market higher so far this year. That's a change from the bear market of last year. So we'll see how long that lasts. But small caps have a long way to go to catch up to their downtrend. They're still, well, not really. We're looking at 145 and a quarter on IWM. We're at 139.50. And the way this market moves, we could hit 145 and a quarter tomorrow. So we're not too far away from the downtrends. But anyway, so we're in a decent little uptrend. And so our algorithm that trades just based on its computer and all by itself, hands off, we let it go, got us long at around 10 o'clock today. And that was just a nice double bottom of the opening range low. So the market made a low in the first 15 minutes, which is what we use for our opening range, rallied up, pulled back, tested it, found support, gave us a reversal trigger that we've written, one of our proprietary triggers, and the market has rallied the rest of the day. So we're in there around 156.5 on the triple Qs. We're at 158.30 right now. We've booked some profits already. We've reduced a position. Maybe we only have about a quarter of our position left. But it's been a nice run. So I continue to suggest, if you want to day trade in a highly volatile market. When the volatility index, collapses again and volatility gets quiet and the market's just churning higher in a bull market, I don't suggest day trading. But certainly there's some opportunities out there. If you want to understand more how we do it, feel free to contact me. You can email me at our on our website. Just click on the button, email me, ask me questions. Always ask me questions here. You can ask me on the live YouTube question and answers chat. You can also send me direct messages on Twitter. I'd love to share with you how we do this if you want to know. In the meantime, be safe out there. We would still recommend caution. We're only focused right now on the precious metals group, which continues to perform admirably in a big up market, right? So the market's up huge in the last couple of days. You expect precious metals to be down, and they're really not. Gold and silver are kind of flat to up a little bit in the last 2 days, which is very bullish for the metal. Now the stocks are down a bit, but that's the way GDX trades. It's like an algorithm. The S&P goes up, and you short GDX, which is the exchange traded fund for precious metal stocks. We'll see how long that lasts. I think those algos will eventually get burned on that trade. But, yesterday and today, those stocks are down a little bit. All right. You guys have a good day trading out there. Be safe. I'll talk to you tomorrow, 9 o'clock for about 5 minutes. for our morning meeting. Take care, guys.